Some of you may have seen me on CNBC earlier this morning. I was on Squawk Box, and I'm on from time to time, and I can remember vividly a conversation with Joe Kernan. If you're not familiar with that show, Joe's one of the anchors. I don't know, 12, 18 months ago, we got talking about how CNBC could do a better job, et cetera, and I said something to the effect, well, Joe, you could talk as if you have a time horizon for your investments past the opening this morning, maybe to the close. We talked some more, and then he caught me and he said, Bob, you are assuming we are in the position of financial education. We are not. We are in the business of financial entertainment. Think about it. I said, Joe, at least you're being honest. Their job is to get eyeballs. Good news doesn't sell, bad news does. When the markets are in turmoil, viewership of financial television in general goes straight up. And when it's going up or boring, we turn it off. I guess we get what we deserve in some ways. But that was interesting for me to listen to, and I've kept that in my mind ever since. And I think the fear funk has only accentuated that. A manifestation of that in the markets is to observe that the stock market, the Standard & Poor's 500, has a higher dividend yield than a yield in a 10-year Treasury bond. I mean, think about it for even those of you who aren't in the business. A bond has a fixed rate of return. 10-year Treasury, call it 1.8%. You buy that piece of paper, you're going to earn 1.8% per annum for the next 10 years, period, full stop. If you buy the S&P 500 today, you're not going to get 1.8% current yield. You're going to get 2.3% current yield. Can you imagine in the next 10 years, do you think maybe one or two companies might raise their dividend? The only way you lose in stocks versus bonds is if stocks go down in the next 10 years. Now, we'll have some down days. We have some down years. But down 10 years from now, we are in a fear funk. Now, having said that, you might think, man, is he bullish? No, I'm not. I think it's going to be another year like last year where we frustrate the bulls and the bears. First few weeks of this year, we were frustrating the bulls. When we're going to frustrate the bulls and the bears, somebody say, when's the bears' turn? And I said, just wait. We got a lot of time left. And you may know in the last literally 3.5 weeks, the U.S. stock market is up 10%. A lot of people don't even know that. And that's okay. I don't know a lot of things in businesses I'm not part of either, but the market, it's going like this. But that's normal. A little piece of investment advice. I wasn't going to comment on this all, but for all of us, turn the bloody television off. If you're an investor, you're in it for the long term. What happens today, tomorrow, the next rest of this year does not matter. End of that sermon. So let me talk about the biggest risk, in my view, to the economy and the markets. It is, will we import deflation from the rest of the world? Deflation is insidious. It obviously means the price level falls. We entered that during the Great Depression. Japan's flirted with it. I said to somebody recently, Japan's flirted with deflation on and off for the last several years. They said, no, you're wrong, Bob. Last several decades. And that's true. Deflation for investors is not good news, at least for risk assets, stocks and corporate bonds, because it puts pressure on revenue growth, puts pressure on profit margins and therefore profits, and brings valuation levels down. I mean, nobody wins. Government bonds tend to do pretty well. The reason I don't think the risk is very high, now to the less educated on financial market issues, we are flirting with deflation in certain parts of the world at the moment. Japan, parts of Europe. The reason I think we won't import deflation to the United States is that we are the most isolated, most domestic economy on planet Earth. Only 13% of our GDP is foreign trade. 13. Most countries, 30%, 40%, some 50% or more. Germany, for example, 48% of their GDP is foreign trade. They care big time what happens outside their borders. For us, it's only 13. Doesn't mean it's unimportant, but boy, have we blown it out of proportion. My view is the 13% is the tail and the 87% is the dog. And our conversations in the financial business, led by financial television, are mostly about the tail. So at the moment, the tail's wagging the dog. So may I spend a couple minutes on the dog, the 87%. The 87% is kind of how much business is New Jersey doing with Pennsylvania and Texas with Florida. And I mean, we don't talk about that way, but we are a domestic economy primarily. And it's mostly made up of consumers, you and me. So I have 4 tailwinds for the U.S. consumer that I think are worth commenting on. The U.S. consumer is in much better shape than most people give it credit for, in my judgment. Number 1, job growth. In the last 5 years, last 5 calendar years, the United States economy has generated more new jobs than any 5-year period in U.S. history. Period. Full stop. Now, to those who are on the other side of the political discussion, we lost a lot of jobs in the Great Recession. No question about it. I'm not denying that. But most people don't realize how vibrant the U.S. job market is. Usually when I get, I didn't know we had that many jobs, but most of them are part-time jobs, right? No. 89% of the new jobs in the last 5 years are full-time jobs. Whisper down the lane, lazy, people are not doing their homework. They're believing what they hear. And there are more high-paying jobs been added than low-paying jobs. Again, contrary to what most people think. First, positive, more of us are working. Second, we're getting paid more money. Now, this has taken longer, and it's only new. The monthly employment report comes out the first Friday every month. We'll get another one tomorrow morning. We see the average hourly earnings in the 12 months since the last reading. Average hourly earnings in the United States are up 2.5%. That's not a big number, but it's the biggest number since the Great Recession. Trailing 6 months, 2.9%. My guess is before this year is out, we'll be in the mid-3s. Why? Because any time unemployment in the United States gets down to about 5%, U3, there are very bunch of different employment rates. The official U3 rate, and it's 4.9 currently. Anytime it gets around 5%, their spot labor shortages show up, and employers have to pay a little more to get and keep workers. More of us working, getting paid a little more money. Number 3, balance sheets. I suspect there are many in the room who have either paid down some debt and or restructured some debt at a lower interest rate. It just gives you more purchasing power. And that's happened all over the place. The 4th positive, the oil dividend. Oil, in case you missed it, in the last roughly 24 months has gone from $100 to roughly $30 a barrel. That decline puts more money in consumer pocketbooks than the biggest 2 tax cuts America's ever seen. It is powerful. Now you might say, well, what are we doing with that money? So far, we're spending about 1/3 of it, and we're saving about 2/3. In part because it's happened so fast. That's partly why it's not so evident. The hit to producers is immediate. You know, if somebody in North Dakota or South Dakota or Texas or Oklahoma can't produce because the price is too low to make it economical, they lay off a few workers. That is a hit to GDP immediately. The benefit to you and me can take time. Here's my silly illustration. So Ma and Pa go to the gas station every Saturday morning to fill up their car. And a few months ago, Pa observed to Ma, it's costing $20 less than it used to. And Ma says, give me that 20. She takes the 20 and puts it in the glove compartment and locks it up. Next Saturday, same thing. Give me that 20. You know, enough weeks go by, Ma turns to Pa and says, you know, we got a stack of 20s. We can take a vacation. Pa says, where you want to go? The illustration, the hit to producers is immediate. The benefit to consumers can take months. If oil just stops, and there's some evidence that oil has stopped going down, if oil just stops going down, these positives will come running through. Our economy will be a little better than people think. I am not making the case for economy, just making a case for an okay economy. So those are the 4 positives for the U.S. consumer. Real GDP, real gross domestic product, is the primary way economists measure our economy. And in 2014 and 2015, it grew 2.4% each year. I'm a portfolio manager, I'm not an economist, so my guess for this year, 2.4%. Why not? With manufacturing near a recession and foreign trade struggling, both because of the rise in the dollar, to get 2.4, I need 3 from the consumer, which is exactly what you and I did last year. Manufacturing is struggling, rising dollar, and the stock market gets almost 2/3 of its profits from things manufacturing and capital goods related. That's why we're in a profits recession, but nowhere near a general economic recession. Do not confuse the stock market and the economy. They're not like this. They have similarities, and over time they move in the same direction there, but there are big differences. If you're a high-yield bond investor, to touch on a couple of more subjects before I open this up to questions, my view is, or my observation is, that high-yield defaults, that is companies that have high-yield paper going under, are way below normal, but high-yield spreads, the difference between a high-yield instrument and a treasury, is at very wide levels. That's not equilibrium. Either this has to go up or this has to come down. I think some of both will happen. That is, we will have more defaults, primarily in the energy and related patch, and high-yield instruments almost everywhere else will be interesting. Absent a recession. Probability of recession, I said, near zero. If you're a student of the stock market, you know it's roughly 1950 on the S&P. At 1800 just a couple of weeks ago, we think the market was discounting a 50% chance of a recession that we weren't going to get. If we're wrong and we do have a recession, risk to 1600, and if the world comes to believe we're not going to have the recession that we're not going to get, we could be at 2000 very quickly. So U.S. stocks have beaten non-U.S. stocks, and U.S. bonds have beaten non-U.S. bonds almost nonstop for the last 6 years. What's that about? Well, we're going to make America great again. Somebody got it. When the dollar goes up and commodities go down and U.S. growth is stronger than non-U.S. growth, it is virtually impossible for non-U.S. investments to beat U.S. investments. We have to reverse some common, and people have been telling me how cheap Europe's been for years. There's a reason. Everything has its price. We may be getting closer to that point. I wish I had time to develop that. I said I'd comment about Washington, D.C. Let me make 2 comments. I've been asked to stop at 1 for Q&A. I'm going to do that. That's what this is here for, believe it or not. My 2 comments about Washington, D.C. Number 1, the federal budget deficit. One of the unsung positives of the last 6 years has been the collapse in the federal budget deficit. It has fallen in the last 6 years by a magnitude never seen before, from 1.4 trillion, embarrassing, 10% of our economy, to 0.4 trillion, 2.5% of our economy. Now, I am not here to say $400 billion deficit is good news. Do not get me wrong. But it's a lot better than 1.4. The reason the deficit fell, sequestration, which flattens spending by and large. And we've had a modest economic growth pattern, so revenues from tax collections have gone up to Washington, D.C. When your revenues go up and your expenses are flat, either your surplus goes up or in this case your deficit goes down. Sadly, we think the deficit has troughed and will start back up the other side. The other comment I would make is post the election, we'll leave all the in-between out. The most important issue for the markets, there are lots of important issues for us as a society, but for markets, the most important issue is corporate tax reform. There are at least 2 problems. 1, corporate America has the highest marginal tax rate on its business in the world. And number 2, as you're probably aware, we're the only country in the world that does not permit its companies to bring their own cash from overseas back to the U.S. without inordinate penalty. If we don't fix that, I believe there will be dozens and dozens of big multinational companies who leave the United States, which would not be good for jobs, our economy, profits, the markets, and the whole system. So before my head goes to the pillow every night, one of my little prayers is, whether it's Democrat, 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 President, House, Senate, or Republican, 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 or some combination, please, Lord, let them tackle corporate tax reform. Be smart for everybody. So let me conclude with some conclusions. One, while we would have our seatbelt and shoulder harness fastened, we think stocks will remain the asset of choice. Last year, stocks beat everything: cash, bonds, commodities, inflation, everything financial. They didn't go up much, but they did better than anything else. We think that will continue. Two, we think one of the worst investments is a 10-year Treasury. I made that case earlier, whether you agree or not. Three, the Fed is not done normalizing rates. They only did one. They will do some more this year, in my judgment. Four, commodity prices. Commodity prices, and oil in particular, have never made a V-bottom. They've never gone straight down and then straight back up. After big declines, they've always had a multi-year period of chop, creating a base from which they go back up the other side. So if you're a bull on commodities, the best hope I can give you is that we're at the end of the decline and the beginning of a chop process. I suspect there's some possibility of that, but maybe not even that. Number five, keep your eye on U.S. wage rate inflation. I covered that before. Nobody's talking about it. And number six, sadly, we are in a period of mediocre returns. Stocks, over the last 100 years, U.S. stocks have returned 11% per annum. Total return. 9 from capital appreciation, 2 from dividends. My best guess for the next 10 years is 7. 5 from earnings, 2 from dividends. For this year, I think it's going to be frustrating, the bulls and the bears. I hope we're up some. I think stocks will beat bonds, cash, commodities, inflation. So I'm leaving you with, it's tough to make a buck out there. And patience, security selection, leaning against the wind. When it feels like not going there, mid-January, February 11th, when your gut doesn't want to, that's when you need to lead into it a little bit. If you agree with us, no recession. And when we get a little complacent and the thing is up 10% in 3 weeks, don't hesitate to let it go. It's okay. I could go on and on and on, and somebody from the corner said, you already did. So I'm going to stop right there and leave hopefully ample time for questions. I've covered a bunch of things. I left a lot of things out. Yes, ma'am.